Hello everybody and welcome to my usual Friday video entitled The Most Undervalued Growth Stocks. And so feel free to pause on the video to look at my spreadsheet if you're already used to this type of video. I do my best to publish it before the end of a trading day on Friday so it can be useful to most people before the trading window is over. If you're new to the channel, let me just give you a heads up as to what this spreadsheet is all about, right? This spreadsheet is entitled The Most Undervalued Growth Stock, and that means that it's specifically catering to the way that I analyze growth stock on this channel, which is I look at enterprise value over gross profit and variations of the gross profit metric. Why? Because most of the stocks that I cover on the channel are mostly only optimized for gross profit because they are not at that stage where they're trying to optimize earnings and have a P ratio and have a reasonable P ratio and all of that. I tend to focus on stocks that are very early on in their product adoption. My strategy is to get a stock really at the early signs of product adoption when you have like 5% about the population that has adopted the product, and really get out by the time growth stalls, get out by the time the stock is about to be valued on PE metrics. So I don't talk about PE, I talk about enterprise value over gross profit. I use enterprise value because enterprise value takes out debt. I want to penalize stock that has a bunch of debt. And I think gross profit is just the most relevant. Another point of the metric that I use is this is a variation right here. The enterprise value over trailing 12-month gross profit over revenue growth is a variation of Peter Lynch's PEG ratio, knowing that I want this number to be as low as possible. And this number embodies kind of a question: how much am I paying for each percentage point of revenue growth over the next 12 months? How much am I paying for that growth? Am I paying a lot for that growth? Or am I paying really next to nothing for that growth? And I think over the years that has been my preferred metric to look at hyper growth stocks. So again, this type of spreadsheet is not for everyone. The way I value stocks is not for everyone. But nonetheless, I'm happy to do it that way. And keep in mind, I own most of the stocks on this spreadsheet, and I have analyzed in depth most of the stocks that are listed on this spreadsheet. So the usual, which are this week I'm doing the 7 cheapest growth stocks this week. So what are they? Well, this week you may have seen my videos on Lovesac and Sactional. So I've analyzed this company, LOVE, and I don't own it at this point, but the company is so cheap. I mean, it's unbelievable. Keep in mind, I've also analyzed LifeMD on the channel, but I don't put LifeMD because I even don't consider LifeMD investable in like a traditional brokerage account because it's way too thinly traded, so it really doesn't fit here. But Love in my view is investable for me. I'm just talking about me, right? It's no investment advice. Love, in my view, is a very interesting stock. Right now, I'm holding back and not doing anything on it, but if you're interested, it's in the spreadsheet, and it is the cheapest in my spreadsheet now. The second cheapest is STNE StoneCo. So as you know, I love StoneCo on this channel. It's one of my Brazilian stocks that I think is very, very inexpensive right now. Then the third cheapest, now that we have Love being the first, the third cheapest is now HIMS. HIMS is still dirt cheap, still trading at around $10, even though this is clearly a stock in my view that we should trade much higher. It bounced up 30% after earnings, went up to $13, and then it's back down. It's an all too familiar pattern for a lot of the hyper-growth stocks that I have on the channel. 4 and 5 ex aequo are FIGS and SOFI. Now I have a very tiny position in FIGS. I haven't developed the confidence in FIGS that I have in SOFI. I have a much bigger position in SOFI. I'm not adding to SOFI. The number 6 is STEM. So as you know, I've kind of put STEM into my too hard category. But what's interesting to note about STEM is that they just got really cheap. STEM just became quite cheap because they did a capital raise, a capital offering, and so now the stock is breaking my top 5, top 7 cheapest. So I may realize STEM this week and see this valuation is much more compelling for me. And the last one is Nubank. I am still adding periodically to Nubank. It trades anywhere between $4.50 and $5. That is obviously too cheap for a stock that is not only the leader in Brazil, but well on its way to be the leader in neobanking in Mexico, in my view. So I love Nubank, even though when you compare Nubank and SoFi, like Nubank is technically much overvalued compared to SoFi, but you can't really look at the market the same way, right? There are different markets, different apps. I like both. I very much like both. So let me move on to the most expensive stocks in the spreadsheet, which they haven't changed. When a stock is expensive, it tends to remain expensive for a long time. And that's the most expensive is Nvidia. And I've sold out of Nvidia. And by the way, I want to call your attention because Nvidia and Tesla are typically brought up together as these totally overvalued stocks that nobody should ever touch. But when you look at my spreadsheet and the way I analyze stocks, Nvidia is clearly way overvalued compared to Tesla. Tesla is actually, if I look at my favorite metric, right, enterprise value over gross profit over revenue growth, Tesla is actually slightly cheaper than the average for the spreadsheet. So Tesla is not that expensive compared to Nvidia. Nvidia is a fortune right now. I am out. I sold the stock. If it goes down, I will be looking to get back in. Nvidia is the leader in GPUs, and GPUs are central to AI. But it's just too expensive for me. It's just too expensive. You've had 10 or 15 years worth of gains in not much time. So anyways, it's too expensive for me. Shopify, I'm trimming Shopify. I think Shopify is expensive right now. And I've been trimming Shopify. I have a tiny position in Shopify now. Same thing for Shopify. Shopify were to go back down, I would look into adding back to Shopify. My favorite stock in e-commerce is MercadoLibre. So now I'm just gonna go through each mega trend and tell you briefly my thoughts. So the first mega trend, as you know on the channel, is the energy revolution that I look at. I actually consider Tesla and Enphase both being my tier 1 stocks. I've been adding more to Enphase recently, mostly because they're both tier 1, but my Tesla position is 10x bigger than my Enphase position. And so I believe in Enphase. Also when I read about Tesla, their numbers for solar, it's clear to me that Tesla is not winning in the solar space. In the solar space, there's other winners than Tesla. And Enphase, I believe, is going to be the winner in the solar space in the long run. They have the better technology. Microinverters are the way to go. They make microinverters for themselves and for other players, for other manufacturers. There's gonna be a tremendous incentive from the IRA. So I love Enphase right now. I've been adding more to Enphase than Tesla, mostly because my position in Tesla is by any metric as position sizing, it is not reasonable, right? It's absolutely not reasonable, the size of position of Tesla. I'm not selling. You don't sell your winners. You let when it's a winner like Tesla, you don't sell the winner. You let it run. But it would be unreasonable, the size of a position in Tesla. But enough about Tesla. As many of you have pointed out in the comments, everybody covers Tesla, so I talk less about Tesla. STEM, and STEM. It's just so hard to make a decision for me on STEM. So right now I'm still not touching it because it's hard for me to decide. But I will reanalyze it because it got so cheap after that offering. But I am not in STEM. Okay, looking at HIMSS versus Teladoc. So I left Teladoc for a reference here, but HIMSS is still about 3 times cheaper than Teladoc, and it is doing better on every single metric. I like HIMSS better than Teladoc mostly because they are taking the approach of a brand. They operate outside of the health insurance system, which makes them much more agile, and they have a recurring revenue model where they treat a lot of ailments that are to be treated through subscriptions. And so I think HIMSS is one of my favorite companies right now to buy, around $10, still cheap. Even if you look at the chart, like you may have bought it at $5 and you're like, okay, well, it's a double, it's expensive now. I don't think it is, for me at least. I don't think it is. Let's look at data warehouse, data monitoring stocks. This is the future. I believe data is going to be so important. As you know, I'm still out of Snowflake. I still think Snowflake is so expensive right now. I used to like Snowflake when it was, growing at 80 to 90%. But with the dollar-based retention that they have right now, dropping, nearing kind of the other SaaS stocks and the growth being, in my view, equal to the other SaaS stocks, I don't see a reason of paying a premium for Snowflake anymore. So right now, my company that I like the best right now in there is still Palantir, and Palantir may surprise many of you if you like this, because you're like, Foundry is not catching on. No, I don't think Foundry is catching on too much, actually. I agree with that statement. Foundry may catch on in 2025, 2026, but I like the military business of Palantir. They are, in my view, about to become the fourth contractor of the military industrial complex, and I think there's margin of safety in Palantir that helps me sleep well at night. I also like DDOG quite a bit. DDOG is cheap right now. MongoDB is getting pricey. Just saying that. MongoDB is getting pricey, but that's okay, right? It's okay to own a pricey stock. Let me move on to my cybersecurity stocks. Again, CrowdStrike is my favorite in there. Zscaler, I have a smaller position in Zscaler. I prefer CrowdStrike over Zscaler, although I think those go hand in hand, because typically when you're going to get endpoint security, you are going to get zero trust. And Net, I love Net. I wish I could buy more Net, but the valuation is just keeping me away. If only we could have like a drawdown in Net, like a drop in the stock, I would buy more Net. I just think Net is one of these stocks that's just more expensive right now. But they are winning in multiple S curves in my view. Their business model is very unique. The CEO is very, very driven. But it's just very expensive as it is often the case. But when I look at a company like Net and paying up for a company like Net, I have to compare it, for example, with a company like Tesla. And Tesla is obviously different sector, of course, but it's obviously I believe cheaper than Net compared to its potential. Just my view, just my opinion. E-commerce. So as far as the e-commerce go, I was very happy to had a MELI around the 1200s, just under the 1200s. I've stopped adding to MELI. Actually, if you watch early videos, you saw MELI was in the top 5 cheapest, and it went back up in valuation. People are catching up that MELI is the leader again in Brazil, so still cheap relative to a lot of our e-commerce stocks, but I haven't been adding to any of those. Let me move on to payments. So STNE is still my favorite payments company. I believe they have the best valuation, the best positioning in Brazil. They grow slightly faster than PagSeguro, and if you like PagSeguro, you may want to watch my video comparing STNE and PagSeguro. So, love STNE DLocal. I'm still waiting on them to report. They still haven't reported earnings. It's a tiny position, so I don't sweat it. But they still haven't reported earnings, and I'm wondering what's going on in DLocal. They have come under attack with a short report, and it's been an overhang on the stock. And same for Square. Square is under attack by a short report. I made a whole video on the channel about my view about what the short report means for Square. I'm not touching Square. I will note, though, that the growth is showing some signs of stalling at Square. So that may be a flag that this company has reached a large amount of wallets right now. Growth is stalling, so I don't like seeing that at all. So I may be trimming Square actually, but not related at all to the short report. Let me move on to my chip makers. So Nvidia, I'm fully out, looking to get back in. Too expensive. AMD has been going up kind of hand in hand with Nvidia. Not as much, right? Not the same run up, but AMD is going up quite a bit. I don't think AMD used to be super cheap. I don't think you can call AMD super cheap right now. So we'll see where AMD goes. I still own it. I still haven't done anything with that position. If it were to get like above a 1 on a EV to gross profit to revenue growth ratio, I would consider trimming it just like I do for Shopify or Nvidia. Right now, in the chip makers, I like Indie quite a bit. I think Indie is an interesting play. Sometimes I wonder if I should put Indie more into the energy revolution stock because they cater to the electric vehicle revolution, and therefore sometimes I almost wonder if they would fit better in the OEM category than we would do in the chip maker category. Regardless, Indie Semiconductors is pretty cheap, and I like to add at this level, although it's a very tiny position. It's a position I'm building. It's obvious because there's risk, right? 1.35, not that big of a company. There's still some risk going on here. Moving on to ad tech. So Pubmatic and the Trade Desk, not much to say aside from the fact that Trade Desk is getting pricey, but Trade Desk is still growing fast. It's still an outstanding performer over the past few years. And Pubmatic I still have to cover on the channel. So right now I'm not doing much to these stocks. I own both of them. I will cover them on the channel, but ad tech is obviously impacted as the recession we're going through really puts pressure on companies, and companies spend less on advertising. Let me move to lifestyle stocks. So stock that I analyzed this week, Lovesac, right? New stock and a ridiculously low valuation at a 0.06. So this is a very low valuation. I don't own it yet. I still have to make a decision on it. I still have to think over it, but I think it's dirt cheap. I've sold out of Celsius a while back. I'm looking to get back into Celsius, even though it's really holding near 100, so Celsius is doing well. Figs, I've made a few videos about Figs. I think Figs is an interesting play, but their growth has stalled. And so, again, this is the kind of things that give me pause because there's a lot of stocks whose growth is not stalling, and there's a lot of stocks who have amazing gross margins. Lovesac is definitely interesting. I have to study it more, and I've made 2 videos on the channel on it already. All right, moving on to Neobanks. Nubank versus SoFi. I'm buying Nubank because I have much less exposure to Nubank than SoFi. I like them both just about equally. Just so happens right now that Nubank is slightly overvalued, slightly more valued compared to SoFi. That's just how it is right now. If you remember 2 weeks ago, it was SoFi was slightly higher. But I like both of these companies. I believe they could be top financial institutions, within the next 10 years, either Nubank in Latin America or SoFi in the US. The last companies that I look at are platforms, right? Last mega trend is platforms. Platforms have amazing economics. They're amazing businesses. You really hire very few people. You put this platform, and then it's a two-party platform where your buyers and sellers kind of interact with each other, and you're just the rule maker, right? You're just the toll booth. They're toll booth on transactions. So I love platforms. Airbnb is the only platform that I own. I am looking at Etsy and I am looking at Fiverr. I've made a video on Fiverr. I haven't made a video on Etsy yet on the channel. I've made multiple videos on Airbnb. Airbnb seems to be not very popular on the channel based on the number of views I've gotten on that stock. But I like Airbnb. I think as a platform they have a winner take all position. They're clearly positioned to win Gen Z and to win a good share of millennials. So I like Airbnb quite a bit. All right, I am done. This is not investment advice. This is just entertainment. Thank you so much for watching. Please like, please subscribe, and have a wonderful day.